Toby.
You think you're gonna win?
Aww.
You think you're gonna win?
Oh my god.
Good boy.
They are adorable.
Get off it.
Hey, get out of there. How cute are they, crazy animal, you? Come on in. I live in beautiful, sunny Anaheim, California. And well, I'm also a real estate agent here, and I sell a lot of homes in Anaheim. I would say living in Anaheim, it's like a dream come true. Let's go take a look. Hey everyone, it's your favorite Anaheim realtor, Monica Villalobos. Thank you for stopping by and visiting. I have a wonderful guest, a very special guest today. It is my absolute favorite lender that I've known for 8 years. I've been working with for almost 8 years, my entire real estate career. And it is the owner broker of California Coastal Loans. And I'm introducing Dino right here.
Thanks, Monica. Hi, everybody. And thanks for having me on.
Of course. And thanks for having me over your lovely house.
Oh, you're welcome.
We're getting to meet all the goats and donkeys and animals, and I got to see all the gardening and everything. So this is an amazing property, and I feel lucky to be here.
Monica's a city girl on the farm right now.
And so is Toby.
And so is Toby.
Anyway, I brought Dino on because, well, obviously with how the market is, with interest rates as high as they've been, we like to think of different strategies to help our buyers and help make home purchasing more affordable. So there's a little something that we've been hearing about, and it's a rate buy down. But that probably makes absolutely no sense to you, the average viewer. It didn't make sense to me at first either, and I'm in real estate. So I brought Dino on to explain it. So Dino, what exactly is a rate buy down?
Yeah, so there's a couple different ways it can be used, and the one that everybody kind of thinks of it as is that you buy down the rate by paying points. And that's the kind of the normal way of doing it, the old school way that everybody's been doing it. But in light of where the market's at right now and how high the interest rates are, buying down the interest rate just doesn't really work. It's not enough of a savings, and the cost is way too high. So the banks have basically come up with a solution. It's a temporary solution, everybody knows it is, but basically there's a few different options. The popular one's kind of like the 2-1 buy down, they call it, and then the bigger one is even the 3-2-1 buy down. My suggestion is always start at the top. If you can get a 3-2-1, get it. If you can't, get a 2-1. If you can't get that, get a 1-0. Now, I know that's kind of confusing, but let me explain it to you. So basically, let's just say the going rate is 7%, right? Just as an example to use an even number. A 3-2-1 buy down says that in the first 12 months, so the first year, the interest rate will be 3% lower than your start rate. So if you're starting at 7, it's really only going to be 4%. Your payment is going to be based off of a 4% interest rate, which is significantly cheaper than what it would be today for a normal rate. In the second 12 months, so in the second year, it's 2% lower. So now you went from 7 down to 4. The second year is 5%. The third year is 6%. The fourth year is right back to where your actual rate is, 7%. It's a way to basically get people into houses and make it affordable, with the full expectation that you're going to be refinancing. There's the one thing that kind of everybody is agreeing upon, because you know all these analysts and people that predict everything, they can never seem to agree on things, right? But the one thing everybody's agreed on is the fact that the interest rates will drop. The guess is sometime in 2023, probably mid to end of the year, the rates will start dropping significantly. And at that point, you can refinance your loan, hopefully get it down to under 4%. And then the beauty of it is you didn't quite lose out on all that, because whatever the cost was to get it, you're going to get that removed off of your payoff. So let's just say you have a $600,000 loan, and after 1 year, there's, let's call it $10,000 left of savings that you would have had. You now, when we go to refinance, it won't say 600,000, it'll say 590,000.
Oh.
So it'll get reduced off of your principal.
That's great.
It's really
That's great.
awesome.
So it's not just lost money that's just been
That's right.
thrown away. That's great.
And the beauty of it is that you don't pay for it. It's set up in a way to make it where the seller actually pays for it. Toby, does that mean you do or you don't like the program?
Okay, real quick, hold on. I had a thought and I was gonna. Okay. Bye, Toby. So that's really awesome that it goes towards principal.
Yeah.
Because you think like spending this money on a rate buy down is just going to be thrown away if you refinance in a year.
That's exactly right.
So what I see as a benefit in that is right now, while you have less competition of buyers, more sellers willing to give back credits and take lower offers, this is kind of a great time to use this, get a great deal, and even pass that deal on months from now when you refinance, or years from now, depending. Obviously, nobody has a crystal ball. We don't know when it's going to actually happen, but historically speaking, the rates always come down. So
I agree. And so earlier when I said, you can either buy down the interest rate, right? It's like a permanent buy down. But if you do that, you can't buy it down enough, and you're going to end up refinancing, so you would lose all the money that you put in to actually buy down the interest rate. Versus in this case, you buy it down significantly more by 3%, you get the savings passed on to you on your next loan when you refinance.
And so when it comes to getting pre-approved for the rate buy down,
Yep.
Are you getting pre-approved on the original rate?
Good question. Life would be way too easy if we could actually approve people on the lower rate, and we can't. We have to approve the people, and again, in our example, 7%. We approve you on 7% because eventually your rate will get there. So you have to qualify for that, but the payment is lowered to whatever the buy down is.
Another benefit that I see about this rate buy down, and obviously your payment's going to go up every year. You work with a lot of first-time buyers, and being young, starting out, you make more money every single year. So it's just going to even out, if not just make it even easier for you once you get to that point. But by that time, you're probably going to end up refinancing, and you're going to save even more, and you're going to save even more money so that you can get the next property. And then we'll talk again about that, how to buy your next property or your first investment property. But anyway, I'll let Dino keep talking. But how much does this actually cost? And who pays for this cost?
So I'd like to show you, I'll write it out so you can actually see it, but just to give you the quick, simple answer, whatever the savings is over that 3-year period, that's how much it's going to cost. So there's no discount for paying it up front, but basically you're saying to the seller, over a 3-year period, let's just say for example it's $20,000, it's going to save me $20,000. Well, the seller pays that $20,000 up front, you start saving it monthly, and then whatever's left over in that savings, that's what gets transferred into your next loan.
Okay, so there is a fixed cost. That's good. So we can at least figure it out easily. Are you actually seeing this a lot with the offers that you and your agents, he included, are writing?
Yeah. So I think on top of that, you're even starting to see agents get really smart about how to list homes. So what's happening is people are starting to list homes for more than what they actually wanted to, but they're advertising it up front. Will offer a 3% buy down, right? And then they're just right out of the gate saying, this is what we're going to do for you. Raise the price, lower the payment. It's a win for both people, actually.
Yeah. At the end of the day, the most important factor is that payment.
Yeah. And the payment is going to be significantly cheaper to have on the lower interest rate than it is on the sales price. Believe it or not, everybody thinks they want to get that lower sales price.
Yeah.
But it's so much cheaper on a monthly basis to actually have the lower interest rate.
So it's great that you brought that up. I am such a visual person, and I'm sure everybody out there is very similar to me in that sense. Why don't we go check out to see what actually is the difference?
Yeah, I think it's
what
a great
it looks
idea.
like. So let's go check it out.
All right.
Okay, so let me show you exactly how it works. We're going to assume a sales price of $800,000 and a down payment of 10%. That's going to give you a loan amount of $720,000, right? Let's just assume, in this case, the interest rate's going to be 6.5%. The payment on that is going to be $4,551, probably a few cents, but let's just round it off. Okay, so now what we're going to do is we're going to do the 3, 2, 1 buy down. Here's how it works. Okay, so let's start with that original payment we were talking about of $4,551. On the 3-2-1 buy down, the first year, it's going to be 3% lower. So that's going to give you, the original was 6.5%, that's going to give you a 3.5% interest rate. And that payment is $3,233, which means in the first year, the first month, I should say, you're going to save $3,118 a month.
That's a lot.
That's a lot, right? I mean, tell me that's not a better way to go per month than it is to get a $20,000 price reduction. Now let's just assume you keep this for the whole first year. In the second year, it's going to be 2%, right? Because it's a 3-2-1. It's going to be 2% lower. So now it's going to go up to 4.5%. That payment is going to be $3,648. That's a savings of $903 a month. Now, if you haven't had a chance to refinance and it goes a little bit longer, in that third year, you're gonna have a 1% savings. So now you're gonna be up to 5.5% interest rate. And that payment is $4,088, which is a savings of $463 per month. All of this over that 3-year period is going to be a savings of $32,200. Now, let's say you do refinance, right? If you refinance and of this $32,000, let's just say you used $12,200. That's going to give you $20,000 left over unused interest that was already paid to the bank. Well, guess what? Your original loan amount is going to be reduced by $20,000 when you go to refinance. So when we ask for your payoff from the bank, they're going to tell us how much you owe, and then they're going to reduce it by $20,000.
That's great.
Isn't that great?
That's awesome.
So for the first 12 months, and quite honestly, this is probably how long you're going to have the loan, and probably even a little less, you're going to be saving $1,300 a month. That's a significant savings. That's enough to get somebody through this high interest rate environment. So I hope that helps.
And so this $32,000 is the cost that we would need to negotiate from the seller.
Correct.
Okay.
Yep, and you're not allowed to pay for it. The seller is the only person allowed to pay for it. So it has to be negotiated that way. So what you're finding now is a lot of people are starting to raise their sales price by X amount just so they can offer this. And that's a big win.
What's the difference now between a $32,000 price reduction versus the 3-2-1 buy down?
Great question. Let's figure that out. Okay, so just to paraphrase what we've done, right? The 3-2-1 buy down. In the first month, or the first year, I should say, the first 12 months, your interest rate's going to be 3.5%. Your payment's going to be $32.33. And by the way, none of this includes any taxes or insurance or PMI. It's just the principal and interest portion.
Good to know.
The savings over that 3-year period, right, 3-2-1, is $32,200. So now the question Monica had was, what happens if we get a price reduction of $32,200? Is that better than the 3-2-1? So let's take an example of what that would look like. If you remember, the original sales price was $800,000. So if we minus 32,000, and let's just make it easy and say 32,000 instead of the 200, right? We're gonna have a new sales price of 768,000. So 768 minus 10%. Now our new loan amount is gonna be 691,200. 691,200 at 6.5%. The payment's gonna be $4,369. The original one here at 3.5% is $3,233. That is a total difference of $1,136. So you tell me what you would rather have. Have the price reduction at $32,000 or the payment reduction every single month of over $1,000. And one might argue, yeah, but I'm losing equity. So fine, you can argue that, but remember, when you refinance, you're gonna get back that entire unused portion. That's just as good as getting a price reduction.
Wow.
It's even better.
Wow.
Because until you get the rate reduction, at least you have a little bit of a payment reduction and a little bit of a breather. Does that make sense?
Amazing. I mean, the numbers are right there. It makes a lot of sense.
It does. And the fact that you get the money back, the unused portion you get back, that's just as good as this.
Definitely. I'd say even better. But you guys tell us what you think.
Yeah, let us know. And if you have any questions, just write them down below and Monica and I will answer them for you.
Thank you so much for watching, and I hope you enjoyed this video. And if you did, please be sure to like, subscribe, and comment below to let me know what you'd like to see next.
And I got to tell you, numbers can be very overwhelming for a lot of people, but they don't have to be. Just get with somebody that understands them and make sure you game plan. Because if you have a goal to buy by next year, let's get those numbers in now. Let's get the numbers worked out so that we know how they're going to work before the time comes for you to get there. We're not just talking how to save more, right? But we're talking about how much money you have to make, what the ideal payment is, what your budget is, you know, what upcoming expenses you might have. For example, are you going to have any more kids or even have kids for that matter? Any kind of expenses like that, we need to take into account. And we need to make sure that they fit what it is you're interested in, what your budget is, not just the overall general that so many people talk about.
So when you're ready to set this appointment with us, I did link my calendar in the comments below. So please click that link and schedule a time that works best for you. But as usual, it was great seeing you, but we'll see you real soon.
Bye. Thank you.